In today's video, we're going to be discussing why this fund beats Schwab D and JEPI. So we're currently making $104,000 per year, and we're always trying to add to that. So one of our biggest contributors to our monthly income is this fund that we're going to discuss, which is Cornerstone, CRF and CLM. Okay, we have about $400,000 in these funds, and our performance and value is blowing away the market because of these two funds. So you can see that we're up for the year, 15% for the year. We're beating everything. We're almost beating the NASDAQ, but we're beating everything else. S&P is up 7, Dow's up 1, NASDAQ's up 15, and we're up 15. But if you look at a 3-year chart, you'll see that we are absolutely blowing away the market with this strategy. I was at 400% at one point, but that was before the bear market of 2022. And then we had the double rights offering in Cornerstone, which really hurt me right here in this area. That was the first rights offering, and then this was the second rights offering. It was a messy rights offering because of the 2022 bear market, but we're recovering, and we're still up handedly, triple the market almost. So, because you can see here, the NASDAQ's been up 63%, Dow's up 59%, and S&P is up 65%, but we're up 250%. So how is this possible? It's because of Cornerstone. Now, I like Schwab D, and I love JEPI. Look, I have a large amount in JEPI. JEPI accounts for 16,000 there, and for some reason they have it separated here as well. So we have 2 lots of JEPI, 10,000 in JEPI here, and another 16,000 in JEPI up here. Again, they broke that down. I don't know why. We definitely believe in JEPI. It has a 10% dividend. Let's go look at JEPI's website. It has about a 10% yield, and it sells covered calls. So it's not going to move up in price like, let's say, a Schwab D will move up in price. I'll give Schwab D credit for that. But I just want to show you the portfolio of JEPI. They hold pretty much the same kind of stocks that Schwab D holds. Okay, Schwab D holds mainly defensive stocks, and JEPI is no different. See, they have a lot of their exposure in consumer staples, 11%, 4% services, healthcare is 12%. So they have quite a bit of exposure into defensive holdings. And here's their top 10 holdings. You can see healthcare, AbbVie, Hershey, which is defensive. Pepsi is defensive, Coca-Cola, Microsoft's even somewhat a defensive. It's large cap growth, but it's defensive against inflation, and has obviously some of the strongest earnings in the market. So they have some growth in here, but it's offset with a lot of defensives. Okay, this is JEPI. Now let's go look at Schwab D, who has a smaller dividend, about a 4% dividend, 3 to 4% dividend, and it also has defensives. See, if we go in and look at the portfolio of Schwab D, we'll see it also has AbbVie. Verizon's defensive because it's like a utility play with cell phones with a large dividend. Pepsi, defensive. Amgen, healthcare, defensive. Cisco is old tech. It's almost defensive with its dividend. Coca-Cola, Chevron has a large dividend. So they're buying things that have large dividends. UPS is not defensive, has a decent dividend. So they're diversified, but they're mainly concentrated in defensive names, just like JEPI. So Schwab D and JEPI are more defensive, and JEPI sells covered calls, so that caps the upside on some things, while Schwab D, I don't believe sells covered calls, and so that's why if you look at a chart of Schwab D, you'll see that it moves higher left to right over time without any decay or NAV erosion. So NAV erosion is the net asset value, the NAV. It erodes on covered call funds, but and I'll demonstrate that with JEPI. But you see Schwab D, it moves in low left to right, upward left to right movements. By the way, it looks like a good time to buy Schwab D because every time it hits this purple line, which is the 50-day moving average, we see support. So we hit the 50 here, support, it bounced back. We hit the 50 here, support, and bounce back. Now we hit the 50, support, bounce back, and we're currently around the 50 again. So it seems like a decent entry point for Schwab D. The RSI is oversold usually when that gets to around 40. See the 40 here, it corresponds with bounces. If you go see 40 was here on that bounce on the 50. Also the MACD cross corresponds with, you need all three for the breakout. You want the RSI at 40, the MACD to cross, the blue through the orange, and then the moving average to get tagged, the 50-day moving average. So all these are aligning for Schwab D, and I have no problem with Schwab D. It belongs in everyone's portfolio. It's a defensive asset and it pays you a steady dividend, and it's 5-star on Morningstar. However, Cornerstone is 4-star and it beat Schwab D over the last 10 years. I know people don't like to believe me when I say that, but let's look at a chart of Cornerstone really fast, CLM, and you'll see that it looks terrible. See, it's not upward left to right like Schwab D. It moves down and to the right. So it's not, it's the opposite of Schwab D. And this scares the heck out of most people. They think it's declining NAV, declining share price. But the share price might be declining, but the NAV is not. The net asset value, you have to learn about Cornerstone. It's the greatest wealth builder in the world, I think. Its NAV has been accretive this whole time because it has special features that adds to the value of its NAV, which I'll teach you right now. So Cornerstone, okay, again, 4-star fund. So for something that drags through the mud that badly, it shouldn't be a 4-star fund, and yet it beat the S&P. So the index, purple, CLM being blue, $50,000 it made over the last 10 years. 50,000 versus everything else was 40,000. Okay. Now, if you want to go check out what Schwab D did on a $10,000 test, let's do it. Schwab D, okay, U.S. dividend, 5 stars. So yes, hard to compete with 5-star, right? But what made the most money? Well, Schwab D only made 40,000. It made less than 40,000. So the index is the maroon, Schwab D is the blue, and it did outperform this index, whatever index that, it's tracking the Dow Jones 100 dividend index, by the way. So the Dow Jones dividend index, which is maroon, made about 34,000, and Schwab D outperformed that. That's great, but it didn't outperform the S&P. The S&P made 40,000 over the last 10 years. So, people want to say that Schwab D is the greatest thing since sliced bread, and it is a great fund. I'm not going to knock it. It's made a lot of money, but look, the S&P made 40,000, and now it's just pulling back to 34,000. So the S&P made 40 because we're on SPY here, which, by the way, is a 4-star fund. You cannot do better than the S&P. The 90% of traders lose, and 90% of fund managers cannot beat the S&P over time, and that's why it's 4-star. And it moves upward left to right on its chart. But Cornerstone is 4-star as well and made 50,000. So, and then people want to know, how is it getting this yield? Is it some kind of Ponzi scheme? They always say that. Well, look at its portfolio. It owns the S&P 500. It just distributes the gains in the form of a dividend. So look at the holdings, okay? Same allocations as the S&P. And then here are the top 10 stocks: Apple, Microsoft, FANG, United Health Group, Berkshire Hathaway, Tesla, JP Morgan, Merck. This is kind of what the S&P looks like, essentially, and the NASDAQ. The CRF tracks the NASDAQ, and CLM tracks the S&P, roughly. So, look, it has all the top names that you would want to see. Coca-Cola, MasterCard, these are in the second page here. These are just the top holdings. It holds the entire S&P and NASDAQ. So, and hey, look, they even have 33% women directors. Who would have thought that was an important stat? Great, I'm glad, but I didn't know they tracked that stat. Okay, so back to the important stuff. So that's the first thing. Cornerstone beats Schwab D. But how? How does Cornerstone beat Schwab D and JEPI, which I didn't show you a chart of, but JEPI, it doesn't have enough information on Morningstar to show because it hasn't been out long enough to see what it's earned over the last 10 years, but I showed you its holdings. It has defensives just like Schwab D. Now, Cornerstone, I showed you its holdings. It has defensives on that second page, but it mainly tracks the S&P, which I just proved to you beat Schwab D. Okay, the S&P beat Schwab D, and Cornerstone beat the S&P because Cornerstone made 50,000 on that chart that you just saw on Morningstar, and Schwab D made less than 40, and the S&P made 40. People on Reddit battled me endlessly, telling me I'm lying, telling me I'm pulling up the wrong stats, telling me I won't go look at their stats, I'm just using my stats. Well, Morningstar is the best ratings agency out there for funds. So I'm just going to stick with these facts. Now, I'll teach you why. Let me show you why. The reason why Cornerstone is so great is because of the DRIP, the Dividend Reinvestment Program. It drips at NAV, not the market price. So whenever I get a dividend from Cornerstone each month, which is about $7,000 a month, okay, they give me the price at NAV, which is around $6.50 a share. See, the current price of Cornerstone is around $7.40, but the NAV is in the sixes if you go to its website. Would you like me to go to the website first? Okay, I'll go check out the website first. Let me see if it's in here. Net asset value, Cornerstone. Okay, the NAV price is $6.78, and so there's a premium right now of 15%. Usually, that's 30%. So we're undervalued in Cornerstone, in my opinion, because the NAV is usually runs at a 30, again, the market price runs at a 30% premium to NAV on average. In 2021, it was running at a 50% premium to NAV. So we're making lots of money. All of us Cornerstone investors, we're making tons of money in 2021. And last year, we still outperformed the market because of this strategy. So look at this drip here. See this NAV right here, 633. The market price, the stock price never reached that. But it gives me this drip automatically. So my dividend gets reinvested. My $7,000 automatically gets reinvested into this. So I make I make 3,500 from each fund. 35 from Cornerstone, 35 from CLM. See there, 3,200 plus the 500 that were up. So every month it does this. Every time you see a 17% gain somewhere, that's because of the drip. So, and I have tons of lots on Cornerstone. So, but here's it just drips every month. Okay, you'll see some substantial losses, but the dividends have paid a lot of these back. And so, once again, the drip. Let's just go higher because I can definitely see them in here. The drip. You saw that instant gain there. Here's another drip lot here at 660, 3,000, 660. So anytime you see around the beginning of the month 3.3 or 2.7, usually the dividend comes in about 3.3 or the first of the month, but then they reinvest it at about the 6th or the 7th of the month. So that's why you see 2.7 on the date over here. 2/7/2023, reinvest at the NAV, not the market price. Instant gains, instant 17% gain there, 12% gain there. So this is how Cornerstone and this is how the CLM CRF are beating Schwab D, how they're beating JEPI, how they're beating the S&P, because they own the S&P in their holdings. Okay, so they track the S&P. However, they take the dividends and they reinvest it back at the NAV. So you're getting a special deal here with Cornerstone. I've never seen any other fund like it. You have to call in. See my last video on how to drip Cornerstone, because you have to do it right. You have to call your broker and ask for the corporate sponsored drip to do this. Again, go check out that last video. You'll see it under how to drip Cornerstone. So Cornerstone, it looks like it's had this massive drop, which I showed you. Currently, it's paying 19% monthly yields. But it's everything is perfectly normal here. The market's been dropping, so it's following that. But before it has its rights offering every year, typically every year, you'll see that run up to NAV, run up from NAV about 30% premiums. So at about 30% premiums. So look here, you see how 2021 we had the rights offering right here. Well, every time we have the rights offering, it stabilizes like this, and then it resumes its uptrend higher. And you see this big uptrend, okay, from about $11, it looks like, from about $10 to $11 right here to about $15, okay? So from 10 from 10 to 14, roughly, you could say, that's 40% premium. Okay, so it was running a 40% premium before the next rights offering, which dropped it. Okay, and then it did a double rights offering. It had a spike up there, and then the market kept crashing, so it had to do it had to cancel the rights offering and resume the rights offering right here. And now it's just now finding its footing, and it's about to, in my opinion, get back above this orange 200-day moving average, and resume its upward march to at least 8 to get to that 30% premium to NAV. And so whenever you get the 30% premium to NAV, you sell. Okay, so you take your Cornerstone funds and you sell after the 30% premium, and you wait for the rights offering, and you rebuy after the rights offering. So you sell here and you rebuy at these lows. And how do you, it requires timing, like it says in my title, but how do you know how to do this? First of all, I'll be there for you. So subscribe to my channel, and I'll be keeping a close eye on this for you every day. And when the rights offering comes, the news alert drops, you see the news in your E-Trade account, you sell everything, okay? And then you sell all but 3 shares, to tell you the truth, so you can still qualify for the drip. Okay, again, see my past video on the drip, or feel free to reach out and ask me questions. And then you simply sell, wait for the stock to drop, and you buy back at when the rights offering is finished. They'll give you another headline saying the rights offering is finished, it went well, yada, 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 and that's when you rebuy your shares at the new NAV price. So they'll drop the stock back to about 10% above the NAV, usually about 12% above the NAV, 112% above the NAVs. And so you want to do the rights offering because it's giving you sell out, you take the whole profit, and then you just send your money over to Cornerstone if you want to do it their way, or you can do it manually and buy it yourself. And they'll just simply buy it for you at the low again. So you sell out at the high when they tell you to, and they rebuy it for you at the low. And then you just keep taking those 30% premiums every year. So you can get up to 30 to 50% premiums in the stock price. You can get a 20% dividend from the yield, and then you drip that dividend, which comes out to another 10% or so that you can make in this fund. I make about 10,000 or so more in this fund every year because of the drip alone. So you, once again, you buy Cornerstone before the rights offering, take the run up. You buy it after the rights offering, okay? You take the run up 30% past the NAV. Then you wait for the headline. You can it can stay at the premium for at a high premium for quite some time. I remember when we were at 40% premiums or 50% premiums, it stayed there for a couple of months before the fund announced the rights offering. So you sit there and hold it, and you wait till the rights offering comes, you sell it all, and then you let the fund buy it back for you at the lows. So it's very easy. It just requires discipline to just watch every day the headline and then sell everything, buy it back. And a lot of times I had a problem with this. I didn't want to sell everything. I sold half my position because I loved it so much, and I didn't want to break up my qualifying income to the banks, because see, that's how I operate. I collect these dividends every month, and I don't like to see a break in my dividend earnings, because then the bank sees a break in my quote unquote work history. So if you want to live free and not have to have a job, like I want to do, well, actually, I don't mind jobs. I think you should do both, a job and invest in Cornerstone on the side. But for me, jobs weren't even as secure as these payments. I prefer 4-star funds that are paying me monthly dividends as a paycheck rather than my own employer, because my employer will fire me at any time. There's no love in a company. I've made past videos about how high-paying jobs are misleading, because even if you take that money, you have to put it in a 401k, and you can't grab it until you're 70. You have to work your whole life just to get this retirement, which might have not even been there for you if the market drops. I prefer Cornerstone and operating out of my own brokerage account so that I can pay myself the dividends along the way, which qualifies to banks. I don't want to have a 401k that pays me capital gains like a Schwab D. If you have all of your money in Schwab D, either in your own brokerage or in a 401k, you might make some money going upward left to right. Like I showed you on that chart, you might make $40,000 over 10 years. And even though Cornerstone made $50,000 over 10 years, that's not the big advantage of Cornerstone. The biggest advantage, besides the drip, besides the fact that it beat Schwab D in the S&P, is that it gives you qualifying income for the banks. When I had my son in my 30s, I had about 100K, and it was all from UPro. I made a past video on this. UPro took me from like 10,000 to 100,000 over the span of my 20s. But when I got to my 30s and I wanted to have a kid, I wanted to buy a house, the bank would not take my gains. They needed dividend payments, not just a down payment and good credit, but they needed dividends payments, not capital gains, because those are up and down and those aren't reliable. They need steady dividend payments. So once I learned that, I took my margin here and ran it up to 300,000 really quick. At that time, I had like 400,000 because I needed to engineer estimated income of about 50,000 for 2 years. He wanted to see 50,000 for 2 years. So I raised up my margin immediately out of survival for my kid. I needed him to have a house before he was born. And I immediately used my margin to get my income up, and I engineered my paycheck this way. I just used this purchasing power, which you get in every brokerage account, which is for every dollar you get 4 in a brokerage account. So if I had 100,000 in my brokerage, I had 400,000 purchasing power, and I used all of it. Now with my 350,000 here, I have times 4, which is 1.2 million, whatever it is, purchasing power, but I've invested a lot, so it's down to 500,000. And the secret to keeping this and this available withdrawal number can't get to 0, or I'm in a margin call. Someone messaged me last night, am I crapping in my pants for having 300,000 on a margin? I've been doing margin for about 5 years now. I've been trading for about 20 years, but margin for 5. I'm 36 years old. And I have not had any problems. I did get margin called during Corona, but that's because I had all my money in energy dividend funds, AMZA. I loved it because it pays tax-free dividends. Just like my Carl Icahn fund, which pays a 15% yield. Go check that out. Carl Icahn, 15%, made a video on it. It's tax-free because it's an MLP. Those are return of capital dividends. So they pay distributions that are return of capital, ROC, which everyone thinks is bad because you're returning your own capital to you, but not if it's accretive to NAV, to net asset value. Go look that up. Go look up good ROC and bad ROC. And Cornerstone gives good ROC. So you do have to pay some taxes on Cornerstone, but you don't have to pay as much taxes on it as you would a Schwab D. So you get tax advantages with Cornerstone. You get the drip advantage. You get a higher dividend. It made more money than Schwab D. And it acts as qualifying income to the banks. I had another subscriber ask if I can talk quickly about how to negotiate margin rates down. I wanted to make a video on that specifically, but I don't want to have a conflict of interest with my bank because they told me not to promote them or do anything like that. So I don't want to, talk about E-Trade or Scottrade or Fidelity or Schwab. I'll just quickly say that when I had my child, and I had a 10% margin rate, I had to get more active in my trading. So I was already an active trader, so that's what gave me the advantage. I told him I'm actually going to be less active in trading, but I'm going to be bringing more money in from my paychecks because I'm going to leverage that with dividends because I need to rely on dividends now and not so much growth. And that's what made them work for me. Go to bat for me was bringing in more money. So that's how you get your margin rates down. You tell them you're going to bring in more money. And because the higher net worth individuals get better margin rates. That's just a fact. In any brokerage place that you go to, if you are more active in trading, they like that. And so that's a way to get your margin rates down. If you can prove that you're more active in trading, which I could not prove anymore. I was only able to prove that from the past. So they use that to my benefit, even though I told them I was going to not be trading, not taking as much risk because I have a son now. I just want steady growth, but I'm going to need to use a lot more margin to do this. So I'm going to need to use a lot of margin, but how can I do it at a 10% rate and still survive? So, that's how I was able to negotiate my margin rate down. And then last but not least, I just always hit people with the threat of I'll just switch to IBKR, Interactive Brokers, because I saw that their margin rates were 5% for a $40,000 account. And I saw that $1 million, net worth individuals get 1% margin rates. And that's really the secret to life. And the last secret to using margin, is using maintenance, which I've told you about in past videos, but Cornerstone has low maintenance. Schwab D has low maintenance. JEPI has low maintenance, but CLM has 30% maintenance. So 30%, that means that for every 1,000 I invest, only $300 of equity is taken up. So that's how I'm able to run up all this margin and not be affected because equity percentage that it takes up is small. So I could invest another 10,000 in Cornerstone tomorrow, and this available withdrawal would only drop by 3,000, because 30% of 10,000 is 3,000. So my available withdrawal would go to 95. So that's still very, high above zero, which when you're at zero, you're at a margin call, and margin calls aren't even scary. Okay. They give you 7 days to get out of the position or to bring in more money. And sometimes the market reverses and it takes you out of your margin call for you. And if you're in a margin call, they usually do it sometimes I got into a margin call by $1. So if I was in a margin call by $1, they're like, hey, you owe $1 and you have 7 days to bring it in or let the market reverse. So once I found out that margin calls weren't even scary, I stayed with this margin strategy. Plus, I link all of my stuff, all of my investments to the S&P. Cornerstone's the S&P, JEPI, they all have the holdings of the S&P, Dow, and NASDAQ. So if those fall 20% a year, I fall 20% in a year. So it's not so bad. AMSA fell like 50 to 80% in a year. Some of those real estate funds during Corona went to zero. Okay, so that's what really hurt me. I was in a lot of real estate at that time. Now I just tied all my margin to the indexes, and that's how I survive. Low maintenance plays, by the way. UPRO, that's an index play that I have. UPRO right here. We've made videos on UPRO about how 10,000 made you $1 million over 10 years, UPRO and TQQ. But this is 100% maintenance. UPRO, TQQ, 100%. So for every 1,000 you put in those, it takes up 1,000. And so I don't like to put much money in those because it sucks up all my equity and it does not pay a dividend. So, I have a 5K in these smaller amounts, these riskier names. OARC, I have 5K in that, by the way, which we've been making tons of videos on. OARC and Tesla, I'm not sure how they're going to perform over the long run, though, so I keep a small amount in them. We know Schwab D is going to perform well. We know JEPI is going to perform well. I think Schwab D will move up a little bit more than JEPI because it doesn't have the covered call hang that JEPI has. JEPI has covered calls, so it's going to cap the upside sometimes. Schwab D does not have as much of covered calls, if any, I believe, because I went to their website and I could not find covered calls on the Schwab website. So, and that would explain why it has a higher high on the chart, leftward to right, because covered calls cap the upside. You don't get higher highs and higher lows in a covered call fund. So that's why JEPI is going predominantly sideways. If we look at a chart of JEPI, it's going sideways here. And it's because it sells covered calls. It has great funds, no doubt about it. Great stocks within the fund, and it will move upward, left or right, as you can see here. I think they don't sell. I think they sell calls a little further out of the money, so you get a little bit more upside participation. But nonetheless, you will cap your upside with a covered call strategy. Schwab D, you don't have to worry about that. It just goes up. However, the trade-off for Schwab D is that it does not pay you as much as JEPI. Schwab D pays around 3 to 4% dividend yield. JEPI pays you twice that. But then what's better than that? Cornerstone. Cornerstone pays you twice what JEPI pays you. It outperforms Schwab. It gives you tax advantages, and it drips at NAV, and it gives you qualifying income to banks. So I think I've said enough. I'm going in circles now. I'm going to leave it here. If you have any questions on this video, please reach out in the comments section below. Thank you very much.